Hello, you wonderful little giblets. Commissar Bro here today with the business strategy game. That's right. We got a lot of stuff to go over, so let's get poppin'. So, performance charts. We're doing absolutely wonderful. I actually want to start out by mentioning that our investor expectation score right now is 119, and our best in industry score is 100. Our game-to-date score is 113 overall. So, well, looking right here, it's 120, 100, 110. So, bam! That means we are tied for first place out of the thousands of companies that exist in this game. That's right, ladies and gentlemen. We are doing absolutely wonderful, and I'm pretty ecstatic about that. It looks like my strategies have been paying off against my classmates, and as such, that has put me in the lead. Pretty strong lead at that, and I'm making a lot of money. If we're looking at the EPS, my earnings per share is 8.85. We went up another buck, roughly $1.70, $1.67, and then our return on equity went down just a little bit, but still averaging at 28.5, which is absolutely wonderful as far as I'm concerned. And our stock price went up to $182.16. So that's pretty good. Again, to give you a comparison, Nike's stock price is only worth $57.06 to buy. And another big company like Adidas is worth €152. So we are worth more than both Adidas or Nike, which is really, really cool. If we keep growing at the rate that we are growing, next week we will actually be worth more than both of them put together. So I'm pretty ecstatic about that. Looking at credit rating and image rating, our credit rating is A+. Our image rating is 99. Once again, we have a pretty strong lead in image. We're pretty much, when it comes to looks-wise, we're the best-looking company in the business. And we hold that title pretty strongly. The only closest person would be Company F and maybe Company C. But really, Company F is the closest with 76, and they're 23 points down compared to us, where we're at 99, an image rating of 100 being the max you can get as far as I've seen. Our credit rating is A+, as mentioned previously. We don't spend all that much on corporate social responsibility and citizenship, but obviously it's paying off what we're doing. Our bonus point awards, this is something else I'm incredibly happy about. I forecasted everything basically on the dot. What we said it was, when I was thinking the figures were optimistic and that I was actually expecting it to be about 10% lower all the way down the board, we actually told the market what we wanted, and that's what we got. Our forecast was $514 million. We got $513 million, so we were $1 million off within a 0.2% variance. And then our earnings per share, we predicted 8.87, got 8.85. Once again, another 0.2% variance. And our image rating, we were 1 point off. We were thinking it was going to be 98, ended up being 99, so within 1% variance. And we got 2 additional points for hitting it so perfectly on the nail. And as you can even see here, compared to last year, we were 2% off. And then in the first year, we were almost 10% off. But today, this week, we were pretty much right there on the dot. And looking at the world average, it shows you that our classmates were averaging about 7% off, and they missed it. But, you know, we actually got a leapfrog award too, which is pretty cool. I didn't think we would actually get that, considering it was only a 1-point increase. But yeah, we totally got it. So yeah, that's something interesting. Needless to say, we've gotten 3 whole bonus points this whole game so far. So we're doing wonderful in that respect. We utilized all of the capacity of our plants, as you can see here. 100% of the North American plant, 120% of the Europe African plant, and 102.3% of the Asian Pacific plant. Putting in them hours and making lots of shoes. or actually, is this is probably just the average. It's probably not for just our company. Oh, well, ignore me then. Ignore me. What's important, though, is we met our demand, pretty much. We ended up selling all the shoes we needed to sell. And I'm trying to figure out specifically where it's going to tell us that. I don't remember. But here's some good little revenue figures. We haven't paid any dividend payments like some of the people in the game have. We are going to pay some this year so that our investors don't start being like, well, hey, where's my money? I thought I was going to get paid dividends. That's what they want, after all. That's the point of investing in your company, is the expectation to get paid back. One important figure, the most important figure of all this stuff you're going to see right here, is our net profit. Our net profit is head and shoulders above our opponents, with C being the closest at $54 million, but we got $88 million. So basically a solid $32 million extra than anyone else did in pure profit. That's absolutely wonderful. And like I said, that's probably the most important bit of information. Our earnings retained $88 million. From all this stuff, that's the most important thing to know. Something else that's pretty cool to know is our default risk is low. So while everybody else looks like they've been taking out loans or they're not making enough money to pay their loans, they have some pretty rough and tumble situations. C is doing fine and F is doing fine. However, they've got low default risk just like us. And even more so, you could argue that C is probably doing the best in that respect, with that 0.14 debt to assets ratio. And even then, G has the lowest default risk ratio. So it is what it is. Totally. So let's take a look at performance benchmarks. So this shows us how we actually performed here. It shows us how much it costs to make our shoes in year 12. We want to be looking at this one because this is how much we produced everything for. We managed to produce our total average pair of shoes a whole $1 cheaper in 2013, in year 13 than we did in year 12. Pretty much costs went up just a little bit in the other sectors, but by minuscule amounts, not enough to warrant a problem. What else is important to know? Our reject rates are down overall. Yes, they have gone down. Hopefully we can continue to improve that. The quality of our shoe went down just a little bit, but only by about 0.1 or 0.01, so very minuscule. And overall, the rest of this stuff's not that important. Let's scroll down. Operating benchmarks, again, it goes into the branded market segments, how much it costs us to make our shoe, and warehouse expenses, marketing expenses tacked on top, and so on. Needless to say, we're making a good profit off of our shoes. Margin over direct costs, like $10, $13, so not huge, but that's okay. We're making a damn good profit, and we're doing good as far as I'm concerned. We didn't sign everybody I wanted to sign, I don't think. We didn't get Yelin or Shakira Iglesias, even though we bid for them. And I thought we set it up to where I had some high bids going for them. But I must have messed up my bidding process. I should have put them first. I don't know if I did now. I don't remember. But the important part here is I failed the bid. So it did go to Company F. Company of F has a pretty good celebrity base, but still they don't have as many as we do. And it's important to me that we hold on to these contracts. So this year especially, I'm spending some buku bucks to make sure that I get all the people that I want. Because, frankly, as far as I'm concerned, we need these celebrities. We need every single one of them if we're going to be able to maintain our position. Now, I was talking to some of my classmates, and we were actually talking about Oprah Beyonce going up. And I mentioned myself, if you want her, be prepared to pay. Because, I'm going to be paying big top dollar to keep her. So make sure that if you're coming after my contract, that you're coming in strong. So, because we have the excess money to do that. We can do it. No big deal. So some other stuff probably worth looking at. Just looking at our averages and whatnot here. Our revenues have done nothing but increase. They went up another, 53? They went up another $53 million from year 12 to year 13. Our earnings per share have increased dramatically since year 10. They were $2.50. Now they're $8.85. Our stock price has also increased dramatically, has gone up $152.16 in a 3-year, 4-year period of time. Well, pretty much a 3-year. Yeah, 3-year period of time there, because this is all we really count, basically. Our credit rating it did take the dip, but it's going back up. Our image rating is pretty much almost maxed out. I mean, all we can do now is get 100 on it or get less. So we're going to keep working on that. Our global market share has also gone up. We own 25% of the market, averaged together, which is pretty damn strong considering there's 7 companies competing. And that means we own 25% of everything, which is pretty nasty. Most of our sales, once again, came from wholesale. We saw an increase in wholesale, actually, from 6,237 to 7,020. We saw a slight increase in private label sales of about 100. Yeah, pretty much 100 dead on, 101. And then we actually saw a bigger increase in internet sales for year 13 than we saw an increase in private label. Again, private label is not really my go-to. I don't focus too hard on it. We've already got a strong position in the private label market. That's the first thing we did. But I mean, looking at the beginning, we've gone up 1,700. Looking at branded, we actually lost sales from year 10 to year 11 in branded, but then went back and pretty much almost doubled it. And at this point, we are keeping that consistent and constantly increasing. So that's a pretty good idea to look at our performance charts. If we're taking a look at the market snapshot, once again, we can see that we're doing things our opponents are not doing. On the internet segment, we're just selling our shoes cheaper. We're selling a better quality shoe for a cheaper price. We have a stronger advertising base than our opponents. Even probably the biggest competitor I would take a look at due to quality would be Company F here. But I think their price is a bit too high and they're not advertising enough. But they do have celebrity appeal, which helps their point and shows why they actually sold more than the other guys, despite being more expensive. Company C is also being a little competitive with us. Their pricing is pretty strong. They've got some strong advertising, but they have no celebrity appeal, and the quality of their shoe is not as good as ours. So obviously, the quality of our shoe, the lower price, and the celebrity appeal is what's making up that difference in percentage of what we owe. If that percentage is worth it, I'm not entirely sure. But overall, I think we did a pretty good job. The biggest problem that Company C made as well was they did not pack enough shoes for the wholesale segment, as you can see here. They had a shortfall of 161. We had a shortfall of 39, which is not that bad, but I wish we would have been a little bit closer to what Company E did. Company E only had a surplus of about 4, which that means they were right on the nail with where things should go, how much they should sell, and so on. So I kind of wish we would have sold in that same ballpark of shoes. But ultimately, we still hold the largest share of the market in both of these segments, including the private label segment. As you can see here, our opponents are actually offering their shoes on the market, but they're not even getting them sold. This particular example of Company F was because their price was over the max bid, was $43.50. They did $44.50, and basically the stores didn't even consider buying their shoe. It's too expensive, even if it's a good quality shoe. It's the best quality as far as the private label segment goes, but again, they're not going to pay for it because it's too expensive. They offered 300 pairs and didn't sell a single one. However, we offered 723 pairs and sold every single one with a 46.6% market share. Company C was the biggest competitor there, but again, their prices were a bit too high. They went with the competitors. They went with us, they went with A, and they went with F, and bought all of our shoes right off of us. I'm not entirely sure why they didn't go, they didn't buy any shoes from these guys because their SQ rating's too low. The SQ rating that the market is currently looking for private label segment is at least a 4. They're a 3, so they sold no shoes. So basically, Company B and Company E have leftover shoes that could have been sold to the private label had they not either done too high of a bid price or made a better quality shoe in this case. So basically, if they could have combined their strategy together, they would have been good. They would have been solid. So if we're looking at the actual internet segment on these graphs here, I love this. It shows kind of more of a, like, what your position on the market is. We are the big green guys. We're pretty visual, as you can tell. Hard to miss. A, on the other hand, is kind of tiny. E is kind of tiny. E doesn't even exist on the internet segment, which is interesting. Well, they do. They're just really tiny. Yeah, so that's interesting. Anyway, so our competitive strengths, our retail price, our SQ rating, our advertising, our celebrity appeal. Our weakness is the models we offer and the fact that we don't do free shipping. Our strength in the wholesale market is our SQ rating, our advertising, our retail outlets, our retailer support, our delivery time, and our celebrity appeal. But our greatest weakness is the wholesale price. In wholesale, our shoes are pretty expensive compared to our opponents, as you see here. But it's expensive enough to warrant, like, what we do, how much we spend in advertising, how much we spend in celebrity appeal, and how much we spend in this, that, or that. Like, it makes sense that our shoes are this expensive in the wholesale market. And even then, if you compare it to our opponents, our shoe is not that much more expensive. It's $1 more, but you get a shoe that's a way better quality, unless you're looking at company F or E here, or company F, sorry, not F. Yeah, company F. If you're looking at company F here, they have a good price. They have a good quality shoe. But I think their biggest problem is the lack of advertising and the lack of retailer support. Like, I mean, look at how much we spend on retailer support compared to our opponents. We spend twice, literally twice. But they do have celebrity appeal. As far as the wholesale segment goes, this is our biggest competitor. And this is someone we need to watch and make sure that we're not messing up at all. But they did have a shortfall of 112 or a surplus of 112 shoes. So that tells me that they should have been more competitive with their pricing. Maybe even cut it even lower because it probably wasn't low enough. This fellow here is selling his shoes for incredibly cheap. And I think that's why he's maintaining any type of market position at all. But even then, damn, that's a really low price. I don't know if I would sell it for that cheap. I would work more on advertising my shoe and make a better quality. But then again, maybe he's going for more of the private label or something like that. But then again, he's not even operating the private label. So I'm not sure entirely what he's doing. But to see if it works or not will be incredibly interesting. So yeah. That's a lot of good stuff there. That's a lot of good information that we're just kind of throwing around here and taking a look. See, I haven't really forecasted what I'm going to be doing. None of these figures are set in stone. Currently, I don't like what I'm seeing in terms of my pricing strategy. My prices are getting more expensive, and I don't want to have to do that. What I would rather do is make my prices cheaper and just provide more of the shoe. I don't know if I'm going to be able to do that, though, because like I'll have to buy more factories. So, I mean, I could, but again, that's a big risk. I won't have to take out any loans because I'm rich enough now to not have to. But at the same time, I can't help but feel like maybe that wouldn't be the best idea. It would be risky. It would be a risky option to do, but it generally is worth it. I mean, it has not failed me yet. But again, my concern is that my opponents will slowly start to realize what they should be doing as opposed to what they're doing now. So that could cause me problems in the future. But the problem still remains that the only place I'm increasing my market share is in the Asian Pacific market based on my prices, my advertising, and so on and so forth, and my delivery time. And if I get rid of these delivery times, it increases my profit, but it is making it to where my region market share is going down. So I don't know if it's worth it or not. Probably not. I think I should just build more factories, but we'll find out. I'll figure that out, and we'll report on it next week. So anyway, this has been Commissar Bro. Thanks so much for watching. I hope you guys enjoy this series as much as I enjoy playing it and as much as I enjoy sharing it with you guys. This is a really cool game. I know I keep on saying that. I've said it like a million times. But I'm going to keep on saying it because this is a really cool game that I have an absolute blast with. Why are we losing employees? That's weird. But anyway, this has been Commissar Bro, and I'll see all you guys next time.